Welcome to the Get Real podcast, your high-octane boost of in the trenches, tell it like it is reality therapy for personal, business, and real estate investing success. With your hosts, powerpreneurs, Angela Thomas and Ron Phillips. It's time to get real.
Hi, and welcome to the Get Real podcast. This is Angela Thomas, and I am here with Ron Phillips. Hey, Ron.
Getting real.
Let's get real. Yeah, so today, Ron, we're going to talk about being an accredited investor, what that means, why you'd want to be one, how to get there. What was that?
Are you one? If you
are you one? If you are, what do you do about it? Yeah.
What difference does it make?
Yeah. So let's get going.
Sweet. I mean, I think it should be fun. It should be a fun topic, I think, for everybody. There's probably a bunch of people out there who've never heard of accredited investors before, and probably didn't know that there was such a class of investor, or that there were classes of investors at all, really.
Yeah. You would think if you had the money, you would just have access to all the deals, right? That's what I would think if I didn't know any better.
Right. I mean, if the investment's a couple $100,000 and I've got a couple $100,000, I should be able to invest.
You should.
That is not the case, however. There is in the SEC rules, that's the Security and Exchange Commission, in the SEC rules, there is a class of investor called an accredited investor, and certain offerings cannot be made to anybody other than accredited investors. And for the majority of my life, I did not even know that existed. So my guess is there's a whole bunch of people out there who didn't know, who don't know as well. There's probably some accredited investors out there who don't realize that they're accredited investors. Crazy. Yeah. Because it's not like you get something in the mail one day where they go, hey.
Congratulations.
Boom, here you go.
That would be nice. Yeah.
It's kind of like when you lived in Vegas and they have those clubs and restaurants out there where you have to be somebody to get in the door. They have the rope and the very sponsor guy.
There's one key difference there, Ron. So with the cool, exclusive clubs and restaurants in Vegas, if you're an attractive girl and you dress hot, you can get in, even if you're not, part of the club. So I don't think it works like that with investments.
It's not the same. Okay.
It's not the same. What?
Maybe I meant like I don't know, a golf club or something.
Oh, okay. Yeah. Golf club's a little different.
Or something. It's more like that.
Yeah.
I'm sorry. I just pictured the SEC as the big bouncer, but I didn't realize they were going to let in hot chicks. So
the SEC doesn't. They don't care. So
they don't. They don't. By hot chicks, they mean people who made the accredited investor rules, which there are. Should we talk about those?
Yeah, definitely.
I mean, they change them occasionally. They most recently changed the rules after the last downturn, to the current rules, which are you have to make, there's an income and then it's or a net worth, right? So it's income or net worth. And then there's some other ones that pertain to companies and retirement associations, things like that. We're not going to go into all that stuff because it doesn't pertain to nearly anybody who's on here. But if you make $200,000 a year as a single person, or $300,000 a year if you're married, then you're an accredited investor. Or if you have a net worth of $1 million or more, but that does not, this is the piece that they changed. It used to be just $1 million net worth. But there were so many people who had $1 million net worth because they owned real estate in California or on the West Coast or on the East Coast. Well, they kind of lost a whole bunch of money because they were an accredited investor by not because they were, not because they knew what they were doing, but because they owned a house. That's it, really. And so now the new change is you have to have $1 million in net worth, not counting your primary residence. So You can count second homes and third homes and fourth homes, but not your primary residence. All your income properties count. So you just have to have a net worth of over $1 million, or you have to hit the income requirements. Okay.
So Ron, why, you seem to know a lot about this. Why did the government even set up those rules? Like, why does it matter?
Well, it was all set up after the big, huge stock market crash in the 1920s. So the SEC was set up in the 30s. I don't remember exactly what year, but it was set up in the 30s. And then they started coming up with all these rules because a bunch of people got, quote unquote, taken advantage of, lost a whole bunch of money. And it's not unlike what happened after this last crash. The crash happened, and so what did the government do? Well, they came in and they started really hardcore regulating a whole bunch of things in the real estate world and in the banking world. Some of those things had, not the greatest of. I mean, there's unintended consequences anytime you start jacking around with the free market, right? Don't get me started on that. That'll be an hour-long rant about how the government is meddling in our affairs a little too much.
It might be funny though, and it would be real. So.
It certainly would be real, and
I think it would be funny. So.
I don't know. Maybe it might get not safe for work. I'm not sure. But
we could edit it. It's okay.
Yeah.
Just kidding. Go ahead.
So anyway, the government did this to protect people from losing their entire livelihood. I mean, that's really what it was put in place for a couple of reasons. They assume that people who have that much money or that make that much money know what they're doing. Which it's been my experience that that's not accurate all the time. Now, sometimes it's accurate, but sometimes that's really, really bad.
Having a high-paying job doesn't necessarily mean you know how to tell if an investment's good or not. I mean, it doesn't always translate.
Just not at all. Not at all. No. But there's the government trying to make something that works when it doesn't. But the second thing, I understand. And the second reason is that if you have a substantial net worth, then the odds of whatever investment this is completely annihilating your life financially, it's lessened. I'll put it that way. I mean, you can still be imprudent with your money, and you can invest all of your net worth as an accredited investor, and you can lose it all. So it can still happen. But this is to protect, quote, the little guy, the guy who doesn't have, guy or gal out there who doesn't have a whole lot of money to lose from unscrupulous people or just really risky investments, even if the people aren't unscrupulous, right? So that's what it's there for. That's why it came about. That's why it's there. And those are the rules. So
it does make sense.
Yeah. And it's really simple. It's pretty black and white. You either make $200,000 or $300,000, or you have a net worth of $1 million or more, and you're in the club. You don't even have to wait for the invitation. It's just...
Yeah. So say I just figured out listening to this, Ron, that I am an accredited investor, and I want to start seeing those deals. Where do I even go about finding them? I mean, how do you let people know? You don't get something in the mail saying you are one, so how do you send out an announcement that you're ready for the deals, Yeah,
and the people who... the people who have the deals don't get an invitation to your party either, that you just became one. And
yeah, what the heck?
Where you have to go seek out these opportunities. Obviously, there will be people out there who will be marketing them. The rules for advertising these types of investments have been loosened over the last few years, which makes it so that you can see things, even if you're not accredited, you can see things on Facebook that are suggesting, hey, this is what I do. I syndicate money to go buy apartment buildings, or, I've got this company that I'm starting or whatever. You just won't see any of the details. And there's a process whereby they're going to go through to make sure that you're an accredited investor before they give you the details. Or at least they should. There seems to be a whole lot of people out there raising money that should be using private placement memorandums and should be using offering memorandums, and they're not. So,
So you still got to be really careful, even if you are the smart accredited investor, cool club, right? I mean,
Exactly.
Yeah. So I am not in the accredited investor club, and I want to get there. So, I mean, my plan to get there is, I have an awesome job at this company, and I'm starting to invest in single family homes. And my plan is to let those grow, let my net worth grow with those, and reposition with a 1031 into multifamily. And from there, when my net worth is high enough, I will be able to access those accredited investor deals. So I just wanted to tell everyone out there, I mean, there's multiple ways to get there. That's my plan. Ron, I'm sure yours was a little bit different. Your business was involved, right?
Yeah, I mean, if you're a business owner out there, your business has a worth. It's part of your net worth, right? So if your business would be valued at more than $1 million, then you would be considered an accredited investor because it's part of your assets. So it's all of your assets, you know. I can't list them all for you, but you guys know what your assets are. If your assets equal minus your liabilities, that's your net worth, equal $1 million or more, then you're there. And if you're not quite there, then you know you can acquire some more assets. Given some time, those assets will hopefully grow, won't lose value.
So Ron, can you talk about? I know you are there. Sorry, I didn't mean to interrupt you, but can you talk about like why you'd want to be there? Like why are these deals so much better? Why are they hidden? Why are they cool? What's the point?
And let's be clear. Some of them are that much better, and some of them aren't better at all than the stuff you were just talking about, Angela. Right. The family deals or duplexes or small multifamily stuff that you can get into, and that's where you need to understand how to read the private placement memorandum, because in there it's gonna go over, you know, kind of the offering, the terms, the risk factors, and, you know, if it's anything like the ones that I put together, the risk factors, I mean, it's a huge list. If you read all of that and you still want to invest afterwards, you really want to invest, because that stuff, like, you put everything that could possibly go wrong. So anyway, kind of description of the company, the management, how all that's going to work, how the proceeds work. So when monies come in, how they get distributed, description of the securities that they're there, and any exhibits that go along with it. And so it's quite a packet. And you need to be able to look at that, and you need to be able to look at the actual investment, the business, the property, whatever it is that they're raising money for, and determine whether or not it's a good investment. And you still have the burden to go out there and look, just like you do if you're buying a house. You have to be able to look at the numbers, and you have to be able to dissect those and make sure that this is going to be a good investment for you. You know, so that doesn't change. But what it does allow you to do is it allows you to look at deals that you otherwise wouldn't have had the opportunity to look at, because the people who have these offerings, and they can be very lucrative. You know, some of my buddies, and I do these as well. You know, you go out and buy apartment complexes, and then you can either rehab them, or you can just make changes in the management. And we'll probably do another segment on multifamily properties, but there can be an upside of millions of dollars in one of those properties. And usually the way these work is that the investors, the money investors, they get what's called a preferred return. So they get, of the money that comes in, of the cash flow, let's say that the property made $200,000 this year, and there were 20 investors. Of that $200,000 that came in, there's going to be a piece of that, a percentage that gets paid out to the investors first. So they get the first money that comes in before the operators or before the managers of that fund get paid. Does that make sense?
Yeah, so that's one of the huge benefits, in my opinion, is you still can make great returns in these bigger deals, but when you're part of a fund like that and you have a preferred return, there's a lot less, or at least a little less legwork involved, right?
Yeah, so it's literally a hands-off passive investment. I'm going to give you money, and I'm going to expect a return. And then what the private placement does, or the offering memorandum, that it lines out how things get paid out. So for instance, if you had one that was paying out a 10% preferred return, for instance, that 10% preferred return would be paid out on a quarterly or monthly or annual, or however it's going to be paid out. And then after that, there's usually some kind of a piece of the upside in the property. So that big chunk that I was telling you about. So,
right.
If the property makes $3 million and you get a 50% of the upside, all of a sudden the investors made $1.5 million to split between them, plus whatever the preferred return was that they were getting. So awesome. It's a way to participate in larger deals, and it's a win-win for everybody, because the guys who are going out there and they're finding these deals, if they have to use their own capital to fund every one of the deals, it constricts the amount of deals that they can do. And it's a win for them, but it's also a win for the money, because usually the people who have the money either don't have the time or don't want to spend the time putting together the deal, or they lack the expertise to put together the deal, and they get a handsome return to utilize their money.
Right. Awesome. Cool. So there's definitely advantages, but you kind of want to know what you're doing, because, the return, I mean, there's a lot of cool things about them, but you could possibly lose a lot more money. So, yeah. Yeah.
I mean, you listen, anytime you're putting up big money into something that is paying high returns, there's a risk reward, right? There's also, offerings for businesses, IPOs, things like that. Yeah, everybody's heard of IPOs before, but those things are also offered to accredited investors, and those are even more risky because they're a startup venture.
Right.
People raise money for apps, for all kinds of things nowadays. And
sure, make it look cool on TV, though. Investing in all those companies.
Right.
Who doesn't want to do that?
I want to see the TV show where they say how many of those were duds and how many of them actually were winners, and then what the payoff is on the back end.
Hey, on that Marcus Lemonis show, what's it called?
The Profit. Yeah, he actually put them on.
He actually had a couple episodes where he went through how many were duds and how many made money, and it's not as many as you would think, but he's still doing all right. So
yeah, he did really well in the others, but it's kind of a gamble. That's a perfect example. So if Marcus was out raising money to go and put money into those businesses, he would need to put out a private placement memorandum because he's selling a security. I guess that's another thing we should say, right? You don't need a private placement memorandum. Like, Angela, if you and I are going to go buy an apartment building together, I don't need to put together a private placement memorandum to go do that. It's just a partnership. You and I are just going to go buy real estate. But it changes when I'm selling shares in a company. All of a sudden, now it's a security because I'm selling shares in a company. And that's why you need to go out there and put together a private placement memorandum, because I'm no longer selling real estate. I'm selling shares in a company.
Yeah, makes sense. Cool. All right. Well, thanks, Ron. And yeah, if you guys have any questions or comments about accredited investing or anything else, or any suggestions on what you would like us to talk about in the future, please visit getrealestatesuccess.com and let us know. We'll look forward to you guys being on next time. Thanks.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.